Silver didn't break $100. It broke the rules. Spot printed as high as $115.59. China pushed futures above 110. And once silver goes triple-digit, the old idea of resistance dies on contact. This isn't a test anymore. It's price discovery. No historical ceiling, no familiar gravity, just a market rewriting what it's allowed to be worth. That shift matters to you because the slow strategy becomes a trap. If you're waiting for $90 to feel safe, you may never see it again. The new support is forming above the breakout, fast, and every hour of hesitation increases the risk of being permanently priced out. But here's the part nobody is saying out loud. Once an asset flips from a value trade to a momentum trade, the crowd stops asking, "Is it cheap?" and starts asking, "Am I too late?" And that single question can move the price more than any chart pattern. So the real danger isn't volatility, it's timing. And what happens next will decide who gets in and who watches it run without them. This move didn't start at $100. It started long before that, when silver stopped behaving like a sleepy metal and started accelerating in a way that compresses time itself. The breakout is the headline, but the real story is the pattern underneath it. Every new price level is being cleared faster than the last one, and the market is adapting to higher numbers almost instantly. That's why $100 didn't hold as a ceiling. It flipped into a launchpad. Look at the speed shift your source describes. Moving from $20 to $30 took 145 days. But the move from $90 to $100 took only 10 days. That's not normal appreciation. That's a different kind of market. One where liquidity thins, buyers surge, and price moves in jumps instead of steps. Now watch how fast this escalates. The conversation is already moving toward $150 within weeks, and even $200 in coming months. Not because people are calm and rational, but because momentum is now doing the heavy lifting. So here's the framing question you have to ask yourself. Are you investing in silver? Or are you trying to keep up with the stampede before the door narrows? The core claim in your material is blunt. Silver is no longer moving in an old cycle. It has entered a melt-up phase where the market punishes hesitation and rewards anyone who already has exposure. And the proof isn't abstract. It's numerical. It's behavioral. It's happening in real time. Your source shows the time compression like a warning siren. The move from $20 to $30 took 145 days. The move from $90 to $100 took 10 days. That's a violent acceleration in velocity, and velocity is the ingredient that turns a bull market into a psychological event. Because when prices start traveling in $10 increments, like they're small, the brain stops treating the asset as stable. It starts treating it as urgent, and urgency pulls capital forward. Buyers don't wait for confirmation. They chase the feeling of being left behind. But here's the part nobody is saying out loud. If silver can jump $10 in a week, then the traditional rhythm, weekly analysis, monthly patience, waiting for the healthy correction, becomes too slow to protect you. The market doesn't care that you want a better entry. It only cares whether there are sellers. Notice what's missing from the entire narrative of wait for the dip. Where is the dip supposed to come from if the sellers are disappearing and the buyers are multiplying? And this is where the story turns from a price chart into a system problem. Because the biggest danger in your source isn't that silver goes up too fast. It's that the infrastructure underneath physical silver starts breaking into two separate markets. And most people won't notice until they try to exit. The warning is specific. Refiners have effectively stopped purchasing alloyed silver products, especially 90% junk silver and sterling. Some are refusing it outright. Others are stretching payment windows from 10 days to as long as 3 months. That single detail creates a hidden split. Pure .999 fine bullion remains liquid, but legacy silver, the stuff people assume is safe, because it's old and familiar, can become a liquidity trap. Now watch how fast this escalates. Dealers rely on speed. They buy, flip, and repeat. But if they can't offload 90% silver to refiners quickly, their cash gets trapped. And if their cash gets trapped, they stop bidding aggressively, even while the spot price screams higher. So the melt value rises on paper, but the real-world realizable value gets squeezed by delays, refusal, and widening spreads. Here's why that detail changes everything. In a high-speed bull market, liquidity matters more than purity myths. If you care about being able to sell fast, the advisory becomes simple. Focus on 0.999 fine bars and rounds. Because in the next phase, the wrong kind of silver won't feel like wealth. It'll feel like friction. The next signal isn't coming from retail. It's coming from a sovereign institution that doesn't move on hype. The United States Mint repriced proof silver eagles to over $170 per ounce, roughly double the spot price at the time. And that isn't a random premium. It's a message. Because when a government issuer sets a number like $170+, it's revealing something about expectations. It's saying, we do not believe this price regime is temporary. We do not want to chase silver from behind. We are pricing for a world where higher levels hold long enough to justify locking buyers into a new normal. But here's the contradiction that makes this explosive. If official pricing is over $170 and local markets are still letting you buy near $110 to $115 with a smaller premium, that gap becomes a strategic window. Not forever, just for now. It's a rare moment where the official price is acting like a future forecast, while the street price is still adjusting in real time. Notice what they didn't do. They didn't price it like a short-term spike that will mean revert. They priced it like a floor is being installed above the old world. And once a new floor starts forming, the question isn't whether silver is expensive. The question is whether this is the last moment you'll ever see it treated like it's still negotiable. Now, the crowd arrives. And when the crowd arrives late, it doesn't arrive calmly. Your source describes a whole new universe of uneducated buyers entering the silver market. Not because they studied supply chains or ratios, but because the price itself became the headline. And once that happens, silver stops acting like a normal asset and starts acting like a signal. This is the Veblen effect in real life. Demand rising because price is rising. The higher it goes, the more people want it, because they interpret the move as proof. Dealers are watching it happen at ground level. Even while buying 6 figures of inventory daily, showcases still end up empty because retail offtake is immediate. Metal doesn't sit. But here's the part nobody is saying out loud. Mania doesn't just drive prices up. It weaponizes scarcity. It pushes premiums higher. It compresses availability. And it punishes anyone who waits for a better day, because the better day doesn't come with product on the shelf. Now watch how fast this escalates. In a frenzy, you're not just competing with other investors. You're competing with emotion, with headlines, with fear of missing out. And that's why the smart behavioral move isn't panic buying into intraday spikes. It's securing access, relationships with dealers, timing during brief lulls, and choosing product that stays liquid when the room gets crowded. Because the next phase isn't about whether you want silver. It's about whether you can still get it. What makes this cycle different isn't just the retail frenzy. It's the institutional silence. Your source signals a shift that would have sounded impossible in the old regime. The short trade is effectively dead. There are 10 million shares available to borrow to short silver, yet there are virtually no takers. Shorting is described as pure insanity. That matters because for years, the silver story lived and died on one expectation. Someone would smash the price down violently, shake people out, and reset the game. But now, the game looks flipped. And here's why that detail changes everything. When the biggest players stop leaning on the Volatility doesn't disappear. It changes direction. The old pattern, waiting for a sudden crash so you can buy the manipulation dip, starts failing precisely when it feels most familiar. Because the absence of aggressive short pressure creates a different kind of instability. Not constant down spikes. Your source goes even further, suggesting banks that historically benefited from suppression are now aligned with the upside. It names JP Morgan as having accumulated physical and now benefiting from rising prices. If true within this framework, that's incentive alignment. The institutions don't want lower prices anymore. They want higher ones. Now stack that with the mania you just saw, a crowd that wants in and a system that no longer wants to cap it. That's how you get $10 moves that happen faster than your plan can update. Now it stops being about silver people and becomes about you. Because when silver breaks into triple digits, the consequences don't stay on charts. They leak into the real economy through prices, availability, and stress. The question isn't whether silver is a good trade. The question is what it says about the system you're living inside. Your source frames this clearly. Geopolitical risk is no longer a temporary spike. It's a persistent bid. Aircraft carriers near Iran, war in Ukraine, aggressive strategic moves like the desire to acquire Greenland. These aren't isolated headlines. They're pressure points that keep fear in the market, even when everyone pretends they're used to it. And that changes what silver represents in your life. It stops being just an investment and starts functioning like insurance. The kind you don't buy because you want drama. You buy it because the world keeps delivering systemic surprise. Events that happen fast and reprice everything overnight. Here's the part nobody is saying out loud. You don't need to be political to feel the impact. You feel it when the cost of basics doesn't come back down. You feel it when uncertainty becomes normal. You feel it when safety becomes a premium baked into everything. If this feels familiar, say so in the comments. Because the silver chart might be screaming profit, but the deeper signal is something else entirely. Confidence is leaking out of the system, and people are reaching for something real. Here's the uncomfortable mechanism underneath all of this. Silver is being pulled by forces that don't care about your opinion. Not politics, not narratives, flows, incentives, arbitrage. The kind of pressure that moves silently until it's too late to react. Your source describes a shift in the center of gravity for price discovery. The Shanghai Futures Exchange is trading silver at roughly a $10 premium over Western spot prices. That doesn't just look bullish. It creates a global vacuum. Because if silver is priced higher in the East, physical metal gets dragged out of Western vaults to capture that spread. And Western markets are forced to respond the only way they can: raise price or lose inventory. This is why the screen price can mislead you. COMEX spot becomes a lagging indicator. It's not the final truth. It's the last known print before the metal gets repriced somewhere else. But here's why that detail changes everything for user behavior. Any dip in US prices becomes a target, not a warning, because arbitrage doesn't wait for emotions to calm down. It buys the discount and ships the supply to where the bid is higher. That means the market has a built-in dip buyer that's bigger and faster than retail. So when people say, "I'll just wait for the pullback," your source is quietly asking a sharper question. Pullback to where, exactly, if the global bid keeps pulling the floor upward? From here, the near future stops being a single prediction and becomes a fork. Because your source makes it clear. Silver is outperforming gold, and that outperformance is the clue. The gold-silver ratio has compressed below 50-1, with gold near $5,000 and silver over 100. That's not just a statistic. That's a signal that silver is in its high beta phase, the phase where it moves harder, faster, and more violently than the asset everyone considers safe. But the smart move isn't to fall in love with the volatility. It's to use it. Your source points to a strategy sophisticated holders are already considering: staggered rotation. As the ratio drops, you start converting some silver into gold, not because silver is done, but because gold locks gains into stability. It's how you take a metal that can double in a short window and translate it into something that can hold purchasing power without wrecking your nerves. Now watch how this escalates in decision pressure. The ratio might fall toward 30-1, even 15-1 in extreme conditions. That means silver could continue to outperform and make the rotation feel painful if you do it too early. But waiting too long carries its own risk. You end up with a portfolio built on speed, right when the market starts demanding defense. So the next phase isn't just how high can silver go, it's when do you convert volatility into permanence? And the answer won't arrive as a headline. It will arrive as a moment where the market starts moving like it's already decided without you. The closing insight of your source is this: the silver breakout isn't a single trade, it's an ecosystem shift. It touches physical liquidity, sovereign pricing, retail psychology, institutional positioning, geopolitical premium, global arbitrage, and even tax policy. And when that many layers align, you don't get a clean ending. Path 1 is the melt-up. Silver behaves like 1979-90-80. Shorts vanish, retail panic accelerates, and a geopolitical shock pushes the price from 100 to 150 and toward 200 in months. Your material even points to an inflation-adjusted theoretical ceiling around 750. In that world, the danger is selling too early because the numbers feel impossible. The correct behavior is not trade the swings. It's hold through disbelief, because the disbelief is what fuels the move. Path 2 is the structural grind. Silver consolidates above 100. Volatility stays, but the floor remains high. Institutional support holds the system together. Mining activity and M&A increase. The ratio trends lower in slow motion. In that world, you don't chase green days. You buy pullbacks. You stay disciplined. And you rotate some gains into gold as the ratio gives you permission. Path 3 is the liquidity trap. Spot remains high, but the physical plumbing fractures. Refiners refuse secondary product, spreads widen, taxes spread, and local shops struggle with cash flow. You're rich on paper, but conversion is painful. In that world, quality wins. 0.999 fine stays liquid. Dealer relationships matter, and gold becomes your density play. So here's the one sentence that reframes everything. Silver over $100 isn't a price, it's a stress test. If you want the deeper layer of this story, the next trigger that could launch, stall, or snap the move, follow and subscribe, because the next phase won't be decided by hope. It'll be decided by who controls liquidity when the crowd shows up.